Okay. Hi, everyone. I hope you are doing well. And today we have the lecture number 9. And this lecture, as you see, is called the smile volatility. So it pretends to make you smile. But okay, let's see. I think it's reasonable to remind you about what was previously on our lectures. So the first, it was that we considered some opportunities for investors. You remember, and it was 3 opportunities. The first, to put your money on the bank account or to borrow from this account from bank. The second, to trade by a risky asset, and the last, to use derivatives. And you remember that all these opportunities is possible for investor if he has access to financial market. So we formulated our main aim to model the dynamic of financial market. And on this market, we assumed that there are riskless risky asset, and derivatives. For a riskless asset, maybe you remember that that we choose the model DB. So if B from T, it is the amount of your money on the time T. So it is proportional by R interest rate, the amount at the moment T, dt. And with initial conditions, the solution of this equation is that BT equals B0 multiplied E to the power RT. Okay. And I would like to choose the other color. Okay. And all about the interest rate, how to compute compounding, discounting, it was in the problem set. So problem set 1. Problem set 1. It is for understanding the full picture, the global one, the global picture of our course. And problem set 1. Okay. The next stop, we choose geometrical Brownian motion as model for risky asset. And it is stochastic differential equation where this WT is a Brownian motion or Brownian process. And maybe you remember what is this, what is properties for this process. And what we need to can after this, it was in problem set 2. Problem set 2. We learn to simulate the different stochastic processes which are given by stochastic differential equation. It was arithmetic Brownian motion, geometrical Brownian motion, Brownian bridge, yes, and how compute the Hurst coefficient. And Hurst coefficient is important for us because he allows to find the difference and to conclude what is this. It is stochastic time series or it's chaotic time series. And if he has the long memory, and we have to find the future value or not to predict. Yes, so problem set and problem 2. Just minutes. Okay. Sorry again. Okay. Okay. After that, we learned the lemma eta. Lemma eta, it is the tool which allows to calculate differential from the stochastic process. So if our stochastic process is given by this equation, so the differential from any function f which depends from S and t, we can write in this form. We can write in this form. But why we need to write it? Why? Because f, it will be the payoff function of call option. But you remember that we are going to model financial market, and it is first riskless asset, the second risky asset, I mean stocks, and the third component, it is we would like to model the price of the derivatives of call option, exactly of call option. So it is lemma eta. And for lemma eta, it was problem set 3. It was problem set 3. Problem set 3. It is how we can use lemma eta. So you see all our pictures. Okay. Go on. After that, we noticed that this differential equation, you see, it contains differential respect to Brownian motion, and this differential equation, and it contains the dWt too, and it is the same dWt, and it is the only source of randomness. So we started to think how we can to get rid of it, and that it will be riskless. And it's easy. And it's easy to conclude that we need to find the linear combination of this and this. So, for example, multiplied this by this coefficient and minus this, and in the result will be without dWt. Okay, for this we built the riskless portfolio, so-called riskless portfolio. It is a vector from 2 coordinates, and the first coordinates, it is how much we take the risk assets 1, and how much the second component, it is how much we take the asset 2. So if we multiplied minus 1, it is amount, by the price, it is f, it will be minus f, and this amount by price multiplied by s, and it will be the value of portfolio. Okay. After that, we assumed that the change of portfolio is proportional by r, the amount of portfolio, and delta t, and we take this value only in a discrete variant and substitute this and this. And after some mathematical manipulation, we obtained the Black-Scholes partial differential equation. You see this. And for boundary condition, we obtained Black-Scholes formula. So it is Black-Scholes equation and this Black-Scholes formula. We remember that it's very important formula, and it was Nobel Prize in 1998 for this formula, and the boom on the option trading. So it's easy to use this formula and to compute the fair price of derivatives. Okay. So now we modeled all three components: risky asset, riskless asset, and the price of derivatives. It's called fair price of derivatives, and we can evaluate this formula by market price. It's premium. After that, we learned a sensitivity of Black-Scholes model. It is so-called Greek letters. It is sensitivity. So how change the call price if we change, for example, stock price. So it is this derivatives, dc respect to ds, the second derivative c respect to ds, derivatives c respect to volatility, respect to time, respect to interest rate. Okay. And finally, we proposed the dynamic delta hedging strategy. And what is this? It is if we have stock prices, we can compute their delta, and after that we found the difference between delta, and this difference defined how much stocks we need to buy or to sell. To buy if the difference will be positive, and to sell if the difference will be negative. So it is like automatically hedging. We need every day how much we need, how much we should to buy or to sell the stocks. Or it can be not stocks, it can be currency or gold or so on. Okay. And and what I need to say you that it was the problem set 4. Problem set 4. In the problem set 4, you need to compute fair price according to the Black-Scholes formula, to build the graph, and to propose the dynamic delta hedging strategy for your data. You need to choose any company to have your data and to propose this dynamic delta hedging strategy. Okay, you see. After that, we can say that that geometrical Brownian motion model is not very good approximation to security prices, and everybody knows this. Why? Because there are some assumption, and its assumption it is hard to perform in practice. For example, riskless rate. Riskless rate, it's assumption about the rate of return or risk asset, that it is constant. And it is constant for lending operation and for borrowing operation. But you know that if you want to borrow money, it is one interest rate. If you put your money on the bank account, it's another interest rate. Yes, it's not the one. It's not the constant. The second assumption, which doesn't hold, it is about volatility. In our model, we assumed that volatility is constant. But how we can calculate volatility? If we have some data, but it can be 100 data and it will be one volatility. If it will be 200 data, it can be other volatility. So it's argumental statement. And the next assumption, it doesn't matter about dividend. Okay, so there are the holes in the assumption of Black-Scholes model. People like the model because they can easily understand its assumption. And really, the model is often good as a first approximation. But if you can see the holes in the assumption, you can use model is more sophistical base. It was even Black who is author of Black-Scholes model, but he was written this. So we have five parameters, and at the first glance, all these parameters are fixed, predetermined, maybe only sigma. Maybe only sigma isn't so true. So T, it is time to maturity. It is how many days from today to maturity. What we can change? Nothing. K, it is strike price. So strike price, we choose strike price and we can change it. Interest rate, maybe interest rate isn't constant, but in this model it's constant. And S, it is the initial stock price. So only for the sigma we have the questions and problem. You remember how we can compute volatility in the Black-Scholes model. For this we need to, if we suppose that SI is the value of our stock on day I, so the volatility per day is just standard deviation, but not for this series, but for series logarithm for proportion SI to SI minus 1. And it's a way how we can find the volatility per day. But if we would like to find the volatility per year, we need to multiply this volatility by square root from 252. And variance rate is the square of volatility. How it looks in Excel. So we have date, we have the prices, we find logarithm, and after that we find difference between this value and this value. It is this, between this and this it is this, and so on. After that we find for this series variance, mean and variance. So it will be 0.081 and so on. But it is volatility per day. But if you would like volatility per year, we need just multiply it by square root from the amount of working day in the year. And in this case, it is 28 and 52%. And I can say that it's approximately usual volatility. So it is from 15% to 15, maybe to 60%, something like this. Okay. So what is our idea? What is this implied volatility? Let me explain this using this example. Okay, for example, we have the time to maturity, the current price, the strike price, the risk-free rate, and the price volatility. So it is our what a given. So we open the Nasdaq site. We choose the trading data, and it is the time for maturity, this, and this. So we chose for data, and T, it is a number of days from today to this data, but expressed in the part of years. So from today to this data, it is this number, yes, 0 point, and you see, and this and this. Okay, after that we can compute D1, D2, F from D1, F from D2, and according to Black-Scholes formula, we can get the call and put. Okay, call and put values. After that, we can compare this value, for example, call for November 16, it is 0.58, but on this, what is on the site? What is the value on the site? But on the site, it is, for example, 0.63. And you see that these graphs doesn't coincide. And this graph, these two graphs don't coincide too. Yes, for put. And our idea, what we can change, that these graphs will coincide. And how we can answer for this question? So we have formula, Black-Scholes for call option, for example, and it is function from 5 parameters. You remember them: T, S, interest rate R, volatility. Oh, no, volatility. Volatility. I need to write. And strike price K. And okay, it is C. But we can on the site the premium, and I can denote it like this, C, with hat. Yes. So we have equation, no, some function from these parameters, equals C. And if all these parameters we count that are given, and only, for example, sigma will be variable. So we can solve this equation and to find sigma. Do you understand? And it will be implied volatility. Do you understand? No? Is it clear for you? This idea? Are you hearing me?
Yes, we understand. Yes.
Yes. Okay, thank you. And I can show you in other way. So it's idea for implied volatility. So the idea that we return a theoretical value equal to the premium, current market price. And it becomes actual during the crash of 1987, not before. Okay. If this is how you can do this using Excel, but maybe I would like to show you this using the Python. And maybe first this, how to model volatility smile in Python. Just a minute. Okay. Okay. So for example, today we have that the price of Google stocks, this 147.6, yes. And for example, we choose the data March 28. So it is from today to this, it is approximately 6 days. Oh, 6 days, yes. 6 days. And 6 days, and we can choose the strike price. It is close to this 147, close to 147, maybe even this or this or this. After that, we go to the Python. We importing libraries, and we installed Median. Maybe I've already showed this, yes, Median. So in this example, it was that the today price was 138. It was really for Google too, but okay, now we can correct. So today it is this. Oh, okay, 147, 147, 47 and 6. So after that, we need to write the strike price. What is strike price? Oh, it's this. Strike price. No, maybe 146. 146. 146. 146. And the amount of days, I said how much? 8? No. Do you remember? 20. Today is 22, but it is 28. Yes? 28. 28. It is 6 days. And 6 days, 6 days. Okay. We can change 6 days. And volatility approximately 20%. So I can compute this call a price value, and it is like like fair price for premium. So if the strike price 146, the theoretical price for premium 2.65. 2.65. But what is in real life? No, very close. 2.85. Yes, you see? Guys, you see?
Yeah,
Yes,
yeah,
yes.
yes, we see.
285. Okay, so we can change this like to I forget. Do you remember? For oh, okay, I need to have a look again. What is 2.85. 2.85. 2.85. Okay, and all this, but it was 6, no 8, 6, 6. I need to change. So you see that in this case, the implied volatility 25%, no 20, but 25, because we have the difference to 85 and to 43, yes? So according to the Black-Scholes formula, the fair price of the call option is 2.43. But you see that on the side, we have that for March 28 and for the strike price 146, the real market price of this premium 2.85. So so we can find the implied volatility. Yes, it's very easy. Implied volatility. So 25. Okay. Okay, we need to return back to our presentation. So, and now we would like to understand, to figure out how we can graph implied volatility smile surface of it is smile effect. You see, yes? And maybe now you need to smile. Okay, so what is the implied volatility? It is graph in the shape of smile, and the minimum value is for the so-called the money options, and volatilities rising to the left and to the right as you move on the other side. Yes, in the money or out the money for put and out the money, and in the money for calls option. And I need to explain to you what does it mean. What is, for example, ATM? At the money, we can note like ATM. For example, the current stock price of IBM stock is $100. Yes, and if we choose the strike 102, yes, this 100 and this 100, it is stock price S and it is strike price K. So if it's at the money, this difference equals 0. So if strike price equals the stock price, so exactly in this point will be minimum for this smile. Okay, if the strike is $80, So for call, the payoff, it is the difference between stock price and strike price, and this value is positive. So it means that the call option in the money. But for put option, for the same strike price, it is out the money, because payoff for put option we can compute opposite, like the difference between strike price and market price, and it will negative value. So it means that the put option is out of the money. And the next case, it is if we choose strike price more than 100. So first we choose the same, and it means at the money. After that we choose it is less than 100, it is 80, and now we choose more than 100, 120. So if we find the difference between 100 and 120, it will be a negative for call option, so call option out of the money, but put option in the money, because in this case the payoff function is positive. Okay, so now you understand this, so understand when it is rising in the money for put option, out of the money for call option. Okay, so you see that for what we can to compute using the median call, we can compute all this delta, vega, gamma. It's called sensitivity, yes, and we can to find implied volatility. So for building this graph, we just need to compute the implied volatility for them, for example, 5, 10 points, and after that join all these points. So we need to fix time, to choose some values of strike price, and to compute implied volatility for each of these strike prices. Okay. How we can model volatility, or how we can to improve Black-Scholes formula in more sophistical ways, and to get the model where the volatility will be not constant. And there are two main models. Its model is called local volatility and stochastic volatility models. First, it is local volatility models. You see that this equation, how we can describe the stock price, is the same. dt, it is dividend, and you can imagine that it is zero. So in Black-Scholes formula, we had ds equals rs plus sigma s dwt, and sigma was constant. But this formula, in this model, everything is the same, only this sigma isn't constant, but the function of S and T, After that, we need to do everything how in the Black-Scholes formula, and to obtain the analog to Black-Scholes equation, and we need to solve it, and we can't to get the solution like in Black-Scholes formula, but maybe using numerical method we can solve this equation. So you see the difference is one. We change the constant, sigma constant, by a sigma like a function. Okay. And the first model for local volatility, it was the Duperret local volatility model, and in this model we can compute this function like sigma square, and it is expressed by this sensitivities value, and its value exactly from Black-Scholes formula. So this exactly from Black-Scholes. Okay. But another model, it is a stochastic volatility model. It is something different, because in this case we have two-factor models. The first value, value, it is like in Black-Scholes formula. Only we assume that sigma is a function from T. And after that, we need to write the differential equation for this volatility, and you see that it is like a diffusion process, and this Wiener process are independent. It is different Windows process. So in this case, the stock price is given by two equations, and for the finding fair price for call options, we need to choose the different ways. So it is like there are two well-known models, Hill and White and Heston models. Okay, maybe you need to know about discrete time stochastic volatility models. It is using for stock price Arch or Garch models, and maybe you know something about this model. Yes, not, I don't know. So it is discrete models, and in this model, instead of Wiener process, you have the white noise. Yes, so it is the process for assets, risky asset, and in this equation you see volatility, and this function, it is the function, stochastic function, and the equations for this stochastic volatility is like in this form. Okay, and the question is, what is your volatility? Constant local volatility or stochastic volatility? And the answer is that all in all, it can be concluded that there is no right model, but a suitable model. Okay, and today I would like to show you the different improving of this Black-Scholes formula, and for example, the model which ideal. Do you see my screen? Yes.
Yes.
Yes. Maybe full. Full. Or anyway. Oh, okay. Okay. So there are some alternatives to the Black-Scholes formula. As I already said, it is this general stochastic volatility model, Houston, Garch, Arch, and other. what is interesting, there are two-factor volatility model when there are not one volatility function, but two volatility functions, slow volatility and quick volatility. There are other volatility where about Levy processes instead of Brownian motion, fractional Brownian motion instead Brownian motion, and the other. And my models which I deal, it is about the change of time, and the idea is the time is relative, and it is maybe a citation of Albert Einstein that time is relative. Its only words depends on what we do as it's passing. For example, in the bed, it's 6 a.m., you close your eyes, but for 5 minutes, it's not 5 minutes, it's already 7:45. But the different situation, if you are in the work, it's 1:30, close your eyes for 5 minutes, but it's just only 1:31. So if we have this idea, we input we input a new time process, not calendar time, but the operational time, new time. And this new time is associated with information flow, because if we have more and new information, the operation time quickly change. So it is, we denote this like T capital from T. So it is stochastic process, and with stationary but not independent increments. And the model now looks like this formula. So you see that left side ds from T, it is like in Black-Scholes model. The first term, it is like in Black-Scholes model, but no, the second is similar. But in this model appeared the second term, and this second term, it is coefficient multiplied d no, differential in respect to new time t capital, and the Wiener process is depends not only on calendar time but on the T capital, so new time. Yes, so it is the first idea. And for this idea, we choose distribution for increments of this new time, and we prove that the process for stocks has a student distribution, and it is desirable effect. After that, we compute the formula for fair price of call option, and we can correlation structure to find, and to model and to compare from real data. And it is my paper on this. About this model. Okay, and there are other model, and this model is connected with new time too, and its model motivated by the COVID situation, where the price can be not changed at the same time. You see, not perpetually change, but we can see this some periods of stagnation. And for this, we have the two news. And a good news, the bad news, it is the Brownian motions are perpetually moving and not adapted for modeling this period where we have motionless stocks returns. But the good news that in statistic physics we have the similar situation. For example, for charge carrier transportation in amorphous semiconductors. So in this model, we have waiting time and heating time to subordinator, and it is like the first time where some process achieve the calendar time t. So the model looks like it is for riskless asset, and it is for stocks. For stocks, you see that we have everything where we need to write T calendar, we write process HT, heating time. And for this heating time, we compute correlation structure, and we compute price for call option, fair price for call option, and to show and to compare option price for this model, compare with option price for Black-Scholes model, and with premiums on the sides. So you see. Okay, and we return back to our presentation. This. Okay, and I would like to show you the literature. It is this handbook, John Hull, Option Futures and Other Derivatives, and you can find the chapter about implied volatility. It is the paper of Bruno Duperry, Pricing with a Smile. Maybe not very simple, but and not very hard. And the link to the link to the paper where we can have a look how we can use Python for calculating implied volatility. Okay, maybe that's all. And now you need to answer the test. And what is this test? Test today is very easy, only 5 questions. First, how we can compute the volatility in Black-Scholes model. It means that we have the historical data, and how we compute volatility. Because we need to find log returns. For this log returns, find variance, and it will be volatility square for per day, but volatility per year, you need to multiply this volatility by 20, no, by amount of working days. So you need this describe this, what is the implied volatility. So it means that you need to write idea how we can obtain implied volatility. If it is, you remember I explained to you that if we have the Black-Scholes equation, and we write this value for the real premium of call option, and assume that the sigma is unknown variable, and after that we solve this equation respect to this unknown variable sigma, so it will be the implied volatility. What is the Smile effect? You need to describe And to explain what does mean call option out money, maybe you need to write example. And the last questions, it is the implied volatility always is greater than volatility in the actual formula. Is it true? Why or why not? Okay. If you understand all this, so maybe you have some questions. Do you have some questions?
No.
No.
No, okay. So now you have some times for answering this test, and exactly in 3 p.m. We can the next meeting. Okay.
Okay.